the metal first, and then the stocks. So yes, I would be accumulating the metal. And that relates to uranium as well. You've got these physical funds out there now that you can buy the physical metal, whether that's the Sprott Uranium Trust, or Sprott also has a uranium ETF that owns as a component physical metals. So you can be buying these physical metals while you're doing your diligence, while you're getting ready to pull the trigger on the related equities.
To meet the growing global demand for a cleaner, greener future, supported by alternative fuel materials, Argentina Lithium and Energy Corp has assembled a first-rate team of experts to acquire and advance the best lithium properties in the world-renowned Lithium Triangle.
Welcome to Inside the Markets, flagship podcast at StockPulse.com. And got with me today Nick Hodge. And Nick has with Digest Publishing, got the foundational profits there. So Nick, it's been a while since we've connected. And I know you're a guy that's in the commodity sector, and so am I. We deal with a lot of these juniors, and these commodities have seemed to be in a bit of a bull market here, but we've got unprecedented times. I guess you've got kind of a dollar who's on the rise, but yet you've got commodities kind of in demand too. So I want to get you on here and kind of pick your brain. And I guess let's pull back here and give us a high level view of how you see things. Inflation just seems to be unprecedented, out of control. A lot of people are wondering, transitory was the word. I think we kind of debunked that. How's Nick Hodge see things?
Yeah, good to be with you, Rob. It's been a bit, it's a struggle out there. I mean, if you look at the broader equity markets, you got a NASDAQ that's down a quarter, 25% since it peaked in late 2020. And you've got an S&P that just entered bear market territory here earlier in June, down 20% from the highs it notched in January of this year. And so that comes amid multiple factors, right? That comes amid a hawkish Fed who's intent on this tightening cycle, on raising rates. And that's not necessarily the best thing when it comes contemporaneously with an economy that's slowing. You had rampant GDP growth in 2021. You remember the stock market was hitting new highs every week, and everything was great. And now you've got to compare the GDP to those euphoric numbers of last year. And when you do that, they don't look so great. And that's really the primary reason that I think broader equities have sold off, is that the market discounts or prices in the rates of change and how key indicators are moving. GDP, I just mentioned, is slowing. You had negative GDP growth, in fact, in the first quarter, and you'll see low GDP growth again in the U.S., I think, for the second quarter. And commensurately with that, you have slowing S&P earnings growth. The S&P 500, all 500 companies in there, just reported their slowest earnings growth since late 2020. And amid all those headwinds, it's tough for commodities to catch a bid. So you've seen those softening as well. I mean, pick your flavor. Whatever it was that was in the headlines last year has completely changed, right? Because things are starting to slow. And so lumber, which you saw in the headlines a lot last year, aluminum, all those things are starting to slow down. And it's tough for the commodity sector, particularly the juniors, to overcome that. And you mentioned inflation, which hurts the consumer, and they've got to figure out where to put their dollars. And so all that makes it a tough environment. So happy to talk about whatever you want to talk about there, just as it relates to gold or anything else.
Yeah, well, I think you painted a picture here of inflation, how to deal with it. I think is probably what we need to talk to. But so yeah, let's get into what causes inflation, and that'll, I guess, determine if it's here to stay or not. So I think we know that the pouring in of dollars or expanding the money supply is probably stymieing us here. So I guess square this with me here. You've got, I guess you painted a picture of a recession. Possibly, Gerald Celente calls this, some call it stagflation. He calls it dragflation, where we'll have no growth at all. So I guess get back to commodities here, to where traditionally that would be a good hedge. But you just kind of painted a picture like it could be a tough road for everybody.
Yeah, that's right. When, the entire broader indexes are going down, it's not like you get to pick one sector that goes up. I mean, only energy really has been the good performer so far in 2022. But when you have the entire market taking a 20 or 25% haircut, it's not like you get to say, okay, my silver stocks or my gold stocks are immune to that. Of course they're not. They get caught up in the selling, and to drill down, I guess, further on inflation. Someone I'm fond of is Mr. James Dines, who actually recently passed away and left me his newsletter, at least to fulfill to his subscribers. And he would always pound the table on, you have to parse out inflation. True inflation is an increase in the money supply. And we obviously saw that in 2020 with multiple stimuluses passed and checks sent out, right? And we haven't had a stimulus in over a year. So what happens is as that money supply increases, that's sort of primary inflation. That's what inflation is. But then you get price inflation as that money dissipates out through the economy, right? And you had people feeling a bit rich, I think, in late 2020 and 2021. And all of a sudden, gas is $4.85 nationwide, the highest it's ever been. Nobody's getting stimulus checks anymore, and wage growth isn't keeping up with the levels of inflation we're seeing. And so people don't feel as rich as they did a year or even 6 months ago, right? And as that, let's call it the wealth effect, shrinks, people don't feel as rich. You've got consumers tightening their belts. You've had warnings from Target and Walmart saying we've got all these goods on the shelf. The consumer's in a pinch. They're not able to spend. And that, of course, affects commodities, right? If consumers aren't going to be able to afford as many widgets as they were before, then you don't need as many inputs for those widgets, whether that's aluminum, lumber, copper, whatever it is. And so I think you get a pause that's parallel with or congruent with the recession and the slow earnings that we're about to see. So, let's say we get 2 or 3 quarters of slowing growth and slowing earnings. It could be, Q4 or Q1 2023 before we get back on the upswing of things. But I think we are in a commodities bull market. I think it's just in a pause phase or a consolidation, if you will. And then, if you want to look at traditional hedges for inflation, like the precious metals, for example, they've not done so bad. If you look at a chart of gold, it's positive for the year. I mean, we just said that the market is down 20% for the year, and flat gold versus stocks that are down 20% is a giant win in the environment we're in. So I guess I didn't even bring crypto into the mix. You're starting to see gold be more of that inflation hedge where it wasn't for the past 2 years, right? Because you've got Bitcoin, for example, that correlates so closely with the S&P that it's basically trading in line with the S&P. It's down significantly this year as well. And so I see those crypto investors, for a couple of years, people were blaming crypto for why gold wasn't going up, right? All this attention is in crypto, all this money's going into crypto. But now I'm getting questions from crypto investors about gold, right? Because they learned about fiat currencies and they learned about rampant debts and they learned all that through the lens of crypto. But now they're seeing that crypto is not delivering like they thought it would, given the amount of money that's been printed, et cetera. And so, I was saying, and I don't know if I've told you this before, but, something I've been saying for a couple of years is that these crypto soldiers were really just in training for the gold army. And I'm starting to see that, develop more.
Yeah, that would certainly help their day. I know some good points there. I've heard those same arguments, and I kind of thought the same thing. So I guess this show's all about trying to get people ahead here, Nick, and make some money for them. So you painted a picture of a storm that's coming here, but there's always ways to make money. So I know, obviously, being a commodity guy, we talked about uranium off camera here, and you like some ideas there. So I guess you have each situation's their own. We're not here to give any specific financial advice, but it's kind of paint people, or put people in a direction here of maybe a good way to go. So talk about uranium. You like it?
Yeah, well, we said that energy is, the only S&P sector that's doing well this year. And inside of energy, that's not just oil and gas. It's also lithium and uranium. So, if you look at the big lithium companies, Albemarle or Cobre, for example, those companies are doing quite well. And then if you look at smaller companies that have recently made lithium discoveries, they're doing really well as well. We financed one here called Patriot Battery Metals. My partner, Gerardo Del Real, was financing that at 15 cents. I wrote a check at 30 cents. They just made a lithium discovery in Quebec, and that stock went over $4 in 6 months. And so there are things that are being rewarded. Another name is Nevada Sunrise Gold, which, despite them having gold in the name, just made a lithium discovery in Nevada as well. And those shares went from below 10 cents to nearly 30 cents in a hurry, and they're raising money here at 25 cents. So discoveries in the energy and battery metals are still being rewarded, and that's a place I think you should look. Uranium has been in a bull market since last fall. The spot prices ran to over $60 a pound. They pulled back this spring, with everything else. But the pullback is a consolidation, I would say. Uranium goes and fits and starts. Even if you look at how the bull market and uranium developed in the 2007 timeframe, it ran up really quick, and then it pulled back, and then it went to the moon, as they say, in 2010 and 2011. And I think you're in that pullback for uranium now, and all the fundamentals for that continue to line up. I mean, just this week, you had the Biden administration request $4 billion to buy U.S. uranium. And that was something that uranium bulls long thought was going to be the case, sort of just how oil prices rose in the 2010s and fracking came online to help the U.S. become quasi oil independent from the Middle Eastern states. I think you're going to see a real push for uranium in that respect now. And that started with the announcement this week, which I think kicks off the next leg of the uranium bull market. That's not to say it can run away independently from the broader markets, but you should be using the weakness that we're seeing now to do your due diligence and start to build or add to positions in the uranium space that you like. I can give names there as well if you'd like. One of my largest holdings is Encore Energy, which I came to own because they bought a small company that I owned called Zarga Uranium, which owns one of the best undeveloped in situ recovery uranium assets in the United States. And they took them out last year, and now Encore is ready to become one of the US's newest uranium producers, up there with UEC and Energy Fuels, for example. And then in Canada, one that I own is Labrador Uranium. So that's a new issue, sort of put together from some Altius assets and some consolidated uranium assets. And that stock ran to, over $1.50 before we had this recent pullback. And now it's down below $1. So one that I would be looking at is if you're looking or interested in the uranium space.
Yeah, a lot of opportunities out there, certainly. So, this market's looking for guidance, I guess, and smart guys like you. I think you just nailed a handful. So, we'll certainly have a look into there. So, let's consolidate a message here for investors, Nick. Is this a time to just find value and where you make a lot of money, or is this time to be kind of scared and maybe kind of sit on your cash for a minute, or how do you see things?
Yeah, I can answer that, I think, pretty specifically. So, on my safe side of things, what I would call my foundational portfolio or my retirement portfolio, I'm sitting in about a third cash. I'm not interested in buying tech stocks. We've been out of tech stocks in the letter since December. I'm not interested in most sectors of the S&P except for, energy and materials and a little bit of utilities. I gave a talk recently, and I think the title says a lot. It was a macro bear hungry for golden lollipop with a uranium center. And so, like I said, gold is holding up well, but the related equities I don't think can do well until we get past that macro bear market. So, we don't need to get into bonds on this letter, but after bonds, because I think rates are going to turn around. So I've been buying bonds. But after that, my next largest position is gold and gold equities. I'm talking first about physical gold, however you define that, in your safe with a tinfoil hat on, or buying GLD in the market, however you want to express that. But the metal first and then the stocks. So yes, I would be accumulating the metal. And that relates to uranium as well. You've got these physical funds out there now that you can buy the physical metal, whether that's the Sprott Uranium Trust, or Sprott also has a uranium ETF that owns as a component physical metal. So you can be buying these physical metals while you're doing your diligence, while you're getting ready to pull the trigger on the related equities, including the junior equities, once this market turns or we get out of this bear market. And of course, I can't say when that will be. be, but I try to keep my finger on the pulse of it every day. So I'm ready to advise listeners of yours and readers of mine.
Yeah. And again, like I said, they need a guru now, unprecedented times. Yeah, I caught a piece you put together on going and seeing a silver mine in Idaho. So I know we're going to see each other here at the Stockpole Silver Symposium in Spokane in late August. So pleased to have you there. Look forward to shaking your hand and seeing some of your chats there. So I guess talk about silver now. Talk about what you think of it. Obviously, you're a gold guy. Well, silver goes along with it. You got a ratio. I guess you can give us a little maybe on your thoughts on the ratio, if that's in line or where you think it should be. And then, talk about your thoughts on silver and then what you might present to us here.
Yeah, I think that silver has attracted a new crowd over the past couple of years, right? You had the Reddit thing in early 2021. You've got the Wall Street silver thing. And I don't think silver can go until gold goes, especially because it's more of an industrial commodity, as many of your listeners will know. So, I think it's almost fallen victim in some respects to the hype that it received over the past 2 years, right? In thinking that there was going to be a silver squeeze. And again, I'll mention, silver going to the moon. And I'll give you a concrete example, because I remember pretty specifically in January 2021 when all of that was, unfolding and silver stocks were going up. And I'll tell you what I wrote to my subscribers is to sell some of your silver shares to these guys that are coming running from Reddit, right? I mean, that's truly contrarian is what you do, right? If you were in silver stocks and you've got a crowd coming running to you telling you it's going to the moon, well, sell them some of your shares. And if you look back at a chart of not just silver, but the related equities and Mag Silver, Endeavor, First Majestic, pick your flavor, you'll notice pretty quickly that they peaked in January of 2021, right when that Wall Street's bets crowd or whatever it was said that silver was going to the moon. So in time, I think silver does well, just like I think gold does well. But not until a post-recession. And so, I own silver equities as well. That mine I was going to visit, I will likely be at your conference. The owner of it was a Silver Hammer mine owned by a company called Silver Hammer. And so, I like silver. I think, silver gets above 30, likely not until gold gets back to 2000 or so, because they trade in tandem. And I guess those would be my thoughts on silver for the current moment, is a bit of caution against this hyperbole that I'm seeing on almost a daily basis. It's fun to post memes about the dollar and the money printing, but that doesn't make silver go back to 30. And in fact, the talk that I think I'm going to give at your conference is, forget going to the moon. Let's start with $30, right? I mean, we haven't seen that since early 2021. And so a bit of temperance, I think, that's not to say I don't like silver, and I'm not poo-pooing silver at all. I own a lot of silver coins. I own a lot of silver stocks, but you've got to be cognizant of what's going on in the broader market and not get caught up in some of what I would say is hyperbole. So I hope I answered your question on silver with that.
Yeah, no, you did. And I think fair enough here. There's always two sides to it. And there's some aggressive camps that are calling $50 silver by the show. So it'll be fun to see. And there's no harm in calling each side. Just, like you said, put out your cautionary warning. Nick, been fun here. How do people get in touch and follow you?
I appreciate you having me, Rob. It's always fun to talk to you about the markets. Digestpublishing.com is the easiest place. You'll see all our products there. And we have a free daily newsletter called Daily Profit Cycle, because everything goes in cycles. And you can find that at dailyprofitcycle.com.
Okay. Nick Hodge, appreciate the time. And we'll certainly look forward to seeing you and checking in on your calls.
Thanks, Rob.